Welcome, and thank you so much for being here for this presentation, Health Savings Account Considerations. This is a part of our webinar series, and we're going to spend about 20 minutes and explain some just really great high-level information on health savings accounts and different things to consider as you're navigating enrolling and managing your HSA. And my name is Jenna Witherbee. I am one of the advisors on the team at 401k Plan Professionals. On behalf of all of us, again, I wanted to welcome you and thank you for being here today for this information. This is a part of our webinar series. We like to, every month or so, take about 20 to 30 minutes and talk about a different maybe 401k or related topic, something in the area of financial wellness. We did debt management, wills, trusts. We've done, okay, let's just start over. Sorry, let's go back. Okay, it doesn't even need to be that long. I can just breeze through these even quicker. Okay, thank you so much for joining us for today's presentation on health savings account considerations. My name is Jenna Witherbee, and this is a part of our team's webinar series. And I am one of the advisors on the team at 401k Plan Professionals. On behalf of all of us, again, thank you so much for being here for today's webinar. This is a part of our monthly series. About every month or so, we have a new topic that we go into. It doesn't need to be 401k specific. Like today's, it's a related topic. It's kind of in that overall financial wellness arena, but we've done a variety of different topics. A recording of this webinar will go out afterwards. And then also it'll live on our website and our YouTube channel. In fact, all of our past webinars can be found on our website, 401kplanprofessionals.com. So that's a really great library of resources for you. Really excited about today's guest presenter, Genevieve Frazier. She is a partner of ours in the health insurance industry, and she's going to talk today specifically on health savings account, but she's really a wealth of knowledge in a lot of different areas, which she will touch on in the next 20 minutes or so. But she began her career in insurance in 2005 after graduating from Minnesota State University, Mankato. She obtained her LUTCF and FSS designations in 2010. She's actively involved in the local Minnesota Association of Health Underwriters and National Association of Health Underwriters. So Genevieve and her team at McGuire Agency are responsible for minimizing your employee benefit costs while maximizing your benefits in a way that helps you stay competitive in today's tight labor market. Their department provides a wide range of admin support and HR tools that can take away the burden of plan administration. And we're really excited to partner with Genevieve. What we do something similar, but more specific to the 401k area, where, like I said, she's an expert in the insurance area. And so she's a great partner of ours. We have gone in on joint clients together. And when it comes to HSA, we get a lot of questions on that when we're doing presentations and say one-on-one sessions with participants when we're looking at their overall financial picture. So I'm excited today to hone in on this HSA piece. She has a lot to share with you, so I will let you take it away. Thanks, Genevieve.
Thanks for the introduction, Jenna. Yes, as Jenna mentioned, my name is Genevieve Frazier. I'm with McGuire Agency. Jenna and I met working with mutual clients, which is fun to do a presentation and meet somebody, and then you click and then you start working on things together. So thank you very much for having me go through the HSA Basics for you guys. So this is actually going to be a two-part seminar. This is going to be the HSA Basics seminar, and then I'm actually going to do a more advanced seminar on HSAs in June. More and more people are introducing HSAs, health savings account, to be paired with a high deductible health plan. And so we're having more questions on it, more interest, more what can I do, what can't I do? So this morning, I'm just going to go through with you some of the basic information. If you have questions or, something I've said in the webinar doesn't make sense, certainly reach out to us. McGuire Agency is a local agency just located located here in Roseville, Minnesota. So don't hesitate to reach out. So let's go through some of the HSA basics. So HSA stands for Health Savings Account. You set up a health savings account with a trustee or a custodian. So that's going to be a bank, a third-party administrator that's going to be able to administer that HSA account for you. The HSA itself, so the health savings account, is owned by that individual. It's not owned by the employer. Contributions that are made to the health savings account can be made either by the individual or by the employer. So either entity can make those contributions. And then it's used, so the funds in there is used to pay for current or future medical expenses on a tax-free basis. And it must be paired with a high deductible health plan. So the IRS has regulations around this that you must have a high deductible health plan in order to contribute to a health savings account. And of course, it's subject to tax rules. So why would you do it? What are the advantages of a health savings account? So they're a powerful tax savings tool. They call it a triple tax advantage. Funds roll over from year to year. So, I think sometimes people are still stuck in that mentality of FSA funds, where it's a use it or lose it. HSA funds are not that way. They roll over every year. And then they're individually owned. So if the employee puts money into the account, they can take those funds with them wherever they go. And then high deductible health plans, or HSAs, are a great way to lower monthly premiums. So I mentioned this previously, so that triple tax advantage. So what does that mean? Contributions reduce your taxable income. Interest and earnings. So if you are in an interest-bearing account with that third-party administrator that I mentioned on the previous slide, those accumulate tax-free. So you don't have to pay taxes on that. And then if you take distributions from them, using them to pay for qualified expenses, those distributions are also tax-free. So triple tax advantage on the HSA accounts. So health savings account contributions. So let's talk about that a little bit. Contributions can be made to the HSA account holder or anyone else, including an employer or a family member. So contributions into the account can be made by either the account holder or the employer. You don't have to. So some people think that because you have a high deductible health plan, you have to have an HSA account, and that's not the case. It's an option. Employer contributions are not taxable. If they are made by the HSA account holder, so the employee, contributions are above the line tax deductions. And if they're made by other individuals, contributions can be deducted by the HSA account holder in determining the taxable income. So contribution limits. So I put 2021 and 2022 on here just because we're kind of in both years. So for 2021, it's 3,600, 2022, it's 3,650. So that inches up a little bit each year. And then for family, it's 7,200 or 7,300 for 2022. People that are 55 and older can actually do what's called a catch-up contribution into an HSA. And what that means is you can put an additional $1,000 over the limits listed here if you wish. So who's eligible? You have to be 55 and over, that we talked about. It's $1,000. And then how does it work? So the maximum annual contribution is $1,000. The catch-up contribution limits is not adjusted for inflation, and it has remained the same every year. And the contribution limit is not reduced for the year if the person turns 55 or older after January 1st. The monthly contribution rule. So this gets into the weeds just a little bit, but basically what it means is you have to be on an HSA plan. So you have to be on a high deductible health plan to contribute to a health savings account. So for each month a person is eligible, they can contribute 1/12 of that maximum contribution. So if it's at 3,650, divide that by 12. And if you were on your HSA, June to December, then you can contribute for those months. But let's say you were on a traditional plan, something that has co-pays on it, the earlier part of the year, you cannot contribute to the HSA. And contribution limits are updated each year, as we just saw in the previous slide. The monthly limit depends on the type of high deductible health plan, self-only or family. And all contributions are aggregated regardless of the source that they come from. So source meaning employer, meaning spouse, right? So if you're somebody that's in that situation where you're transitioning from a traditional to a health savings account, I think it's healthy to have a conversation with a third-party administrator just to be sure you're not penalized. The full contribution rule. So what is the full contribution rule? So it's a special rule that allows an individual who's HSA eligible for only part of a year to make a full year's worth of HSA contributions. HSA contribution limits are determined on a monthly basis. So if a person is HSA eligible for the entire calendar year, if you become eligible in any month other than January, they're HSA eligible on December 1st of that year, or that individual should remain eligible during a 13-month testing period. So again, if you're somebody that fits in this criteria, I do think it's healthy to have a conversation with a third-party administrator just to be sure it's being done correctly. There's a special rule for married folks. So if spouse has family coverage or both spouses are treated as having only that family coverage, then this would pertain to them. So if both people are HSA eligible, so me and my spouse, both of us are HSA eligible, the HSA contribution limit is divided between spouses. So what that means is, as a family, myself and my spouse, we can't contribute over that family amount that's regulated by the IRS. And that rule applies even if the spouse has family and other has self-only coverage. So like, let's say it's me and my two children on my plan at my employer and my husband's on his employer's plan. We all have to monitor that amount as a family to be sure that we're not going over that limit. And the rule does not apply to catch-up contributions that we talked about in that previous slide. So what happens if you don't follow the rules, right? These are the adverse tax consequences of why what we just talked about is so important. So if a person makes additional contributions under the full contribution rule, and then you're no longer eligible for the HSA, so the reverse of it. So let's say I leave my employer and I go work somewhere else, and now I'm on a traditional plan. Those funds that were contributed would be included in that gross income, and they're subject to 10% tax. So you really have two penalties there that you would dip into, which is not good. Eligible medical expenses. So what can I use my HSA funds for? So I just want to talk just briefly about that previous slide. So employers frequently ask me, what are my responsibilities as the employer if somebody is doing this? I always say to the employer that you need to tell your folks that this HSA is your responsibility to manage. You guys you don't have time to manage that for all of your employees. You need to be telling them that is their responsibility to manage these funds appropriately and know the rules. And I've even had employers in the past to provide, a summary like this that says, what are these rules and what do I have to follow in their open enrollment documents as well, if folks have questions. So, okay, so getting back to the slide, eligible medical expenses. So what is an eligible medical expense? So I put this money into my HSA account. Now what can I use it for? So medical care expenses, right? So you go to the doctor, you get a prescription, any explanation of benefits you get in the mail, you can use it for that. So usually what I tell people is you usually get a debit card with your HSA. And you get the bill in the mail, you can flip over the bill and write that card number on there. You can do it online. Prescription drugs, so using that card at the pharmacy. Over-the-counter meds, so that law did change. That was with that CARES Act. So I don't know if you've been to like a Walgreens or CVS recently. You see the little flags that certain med things are eligible, HSA eligible now. So some over-the-counter meds are available again. Dental or vision care. So sometimes dental products have a deductible on them, right? So you can use your HSA card to pay for a dental deductible or out-of-pocket costs that you had at the dentist as a result of a cavity or a root canal. Vision care. So going in and getting your eyes checked, glasses, contact lenses, things like that. Some insurance premiums. So sometimes things that you pay for, you can use your HSA account to pay for. So COBRA premiums. So that would be an employee leaves and they're getting COBRA, right? They can use their HSA to pay for COBRA premiums. Health insurance while receiving unemployment benefits. Qualified long-term care premiums, qualified. And then any health insurance premiums paid by individuals age 65 and over. So once you reach age 65, you can't contribute to an HSA account anymore, but you can use the funds in an HSA account to pay for Medicare premiums. So kind of a neat deal. Record keeping. So I already mentioned this before, but I do get this question from employers a lot. Employers are not required to determine whether an HSA distribution is used for qualified medical expense. So not your job. There are no claim adjudication requirements for employers. HSA account holders are responsible for keeping track of their distribution. So usually what I say in an employee meeting is, if we have the HSA account in place, just be sure that when, you go to the pharmacy and you're getting your prescription, just take that receipt that they give you and stick it in an HSA file with your tax documents, just to be sure that you have a paper trail to go along with those HSA distributions that you're taking out of your account. So employer reporting. So what are you required to do as an employer? So we just talked about what you don't have to do. Now, what do you have to do? So employers must report HSA contributions on the W-2. If an employer is making a contribution for a prior year, by April 15th of that current year, you must do two things. So one, notify employees and the HSA trustee, and then two, report contributions on that W-2 for the current year. And employees make a reconciliation on that form 8889. And then employers that violate these comparability requirements, you have to use the IRS form 8928 to pay the 35% excise tax. So you just have to be careful with how these things are being administrated from an employer perspective. All right, so that is all I have for my HSA basics overview here. Certainly, if you guys have any questions or there's any details that you would like in addition to this, do not hesitate to reach out. We're looking forward to providing you with kind of an HSA 201 class coming up here in a few months. So, Jenna?
All right, thank you so much. That's really great information. Like I said, these conversations and questions come up a lot during our group and individual presentations. So this is really valuable now and to have in the future. So again, thank you so much for joining. This can be found out on our website, 401kplanprofessionals.com, and our YouTube channel. You can search us at 401k Plan Professionals. Thank you so much and have a great rest of your day. Thank you. Bye-bye.
Thanks, everyone.